The Federal Reserve's latest projections show real GDP growth holding steady at 2.2% and unemployment remaining below 4.5% through 2028, mapping a potential path toward a successful soft landing. However, this outlook faces immediate friction. A significant upward revision in 2026 inflation projections suggests that interest rates will need to remain elevated for longer than previously anticipated. While stable growth and employment provide a strong baseline, the persistent nature of current price pressures has led participants to project a more restrictive policy path through the end of the decade. This chart displays the Fed's stable growth outlook. Real GDP tracks between 2.2% and 2.3% over 3 years. Projections for the labor market are equally steady, with unemployment remaining near 4.3% through 2027, before a minor decrease to 4.2% in 2028. These combined indicators suggest the economy is durable enough to withstand a period of sustained high interest rates. This data shows the primary shift since March. June 2026 PCE inflation projections rose from 2.7% to 3.6%, driving the projected federal funds rate up to 3.8%. With inflation running nearly a full point higher, the appropriate policy rate assessment moved higher as well. These persistent price pressures suggest that any shift toward rate cuts will be delayed until inflation shows a clearer downward trend. This chart outlines a 3-stage normalization. In 2026, policy is restrictive, with a 3.8% median rate addressing 3.6% inflation. In 2027, inflation moderates to 2.3%, and the rate drops to 3.6%. In 2028, inflation hits 2.0%, settling the rate at 3.4%. This trajectory reflects a multi-year effort to align inflation with the statutory mandate while growth continues. The updated projections indicate the Federal Reserve's assessment that the economy can handle prolonged policy restraint. These projections clarify that the immediate priority is restoring price stability, with the anticipated timeline for rate normalization now extending out to 2028. The Fed's data-dependent approach suggests that while a soft landing remains the goal, interest rates will remain elevated as long as inflation stays above the 2% target.